Thank you. So welcome to this webinar. And this time I thought we'll do a slightly different type of webinar from the normal ones that I have done. I think you're used to seeing a lot of graphs, charts, things on the market, slides on the market, etc. So this time I'm going to avoid a lot of it. Okay. And I thought, let me go back on some of my learnings from real life case studies that we have seen with our clients, and also others that we people that we've come across. So this webinar is a little bit more on the storytelling side. So happy to also interact with you at the end of the session. Uh, Before we start, yeah, so let me put on a poll, okay? And the poll is, about what's your current stage of retirement planning, okay? So if we can start off on the poll, I think that will be useful. So I thought it would be useful for us to see, where, people who are attending this webinar are on which stage, right? So we'll give a few more seconds for you to complete your poll. Yeah, fantastic. And thank you for your inputs. Okay. And let me share the results. Okay. So we have almost 36% of us who have started, but, have no clear plan. We have another 29% who have a plan but needs review. And we have another 25% who are retired and managing one's own corpus. So I think that's interesting. So uh, I sort of also broken up this section, this session into parts. What do you do before, and just as a little before. Secondly, is when you're just about to start off, and once you have also retired, what is it that you can do, and it's also about what are some of the pitfalls, or what are some of the things that I think from our learnings that you can sort of keep in mind and avoid. Okay, so this is the broad thing. Okay, so I will now stop sharing and get on with the presentation. So it goes right back to the time that I wanted to retire from corporate life. Okay, so while doing this, in fact, Rachna suggested, yeah, why don't you bring up this particular article and sort of use it. Okay, because this was something that got covered in Rediff pretty early. If you see December of 2007, right? And this was sort of my interview there, where uh, you know I shared with them my journey of retirement, and that's what I'm also about to do. Right from the time that I started working, I had set myself a goal of retiring from corporate life by 35 years. Okay. Then I went on to work at Wipro Technologies. I had a reasonably short stint, about 7 years in business planning and mergers and acquisition, almost half the time each in each of them. Okay. And in this journey, because I had set out this goal of retiring from corporate life, I also came across and was working on a few ideas. Interestingly, the idea that I looked at initially was of setting up a retail pharma chain. Okay, that time there was not a single one. Okay, today we have a plethora of them. So one was little early. I looked at doing it along with a colleague of mine, but and he was a lot more senior than me that time. And he kept on postponing, the end goal, saying that, okay, after this and after that. Then I got frustrated and I said, okay, let me do something where I don't have to depend on somebody else. Okay. Of course, for me, I was investing from my 12th standard days. I was investing in stocks. Okay. Then I went on to take up my CFA PhD BA, like Tara read out. Okay, and then I continued to invest in the markets right through my while I was working, and in that journey, I suddenly found that I was coming closer to my goal, and I was seeing that maybe this is something that other people also would find useful. Okay, and uh, if you see that time, you didn't have too much of financial planning. Okay, in 2003, right? Now, of course, financial planning has become a fad, and unfortunately, people, it's an abused terminology, including for selling insurance and stuff. But one did it for the reason of saying that, okay, how do we help people achieve their goals? And I was in the finance department of Wipro and in business planning, etc. I said we are doing a lot of this for corporates. I think this is very, very useful for individuals as well. And that's where I started off my journey. I set myself a corpus of achieving a crore of rupees. Okay, at 35, and when I hit that crore of rupees, I said I will retire. Uh, Now, by God's grace, and also I think because one planned towards it, one was able to achieve it earlier than 35. So I set out and started off Writer Horizons when I was 31. So that is been a little bit of my journey. That brings me back to a few questions, right? So one is, what is retirement itself, right? I think retirement is a state of mind, if you ask me. Okay, and uh, because in some form, you may be not necessarily winding down. Okay, for anybody who knows my routine, it's much more hectic than what it was while I was at Wipro. But it's something that you enjoy, and it's something that gives you satisfaction when you see other people achieve their goals, right? So I'm saying that it's about how you are able to achieve financial freedom is what I would define it as, and to do things that you want to do without having to bother about, do I have sufficient money to take care of myself, right? And that is something which is sort of an important point that I want to bring across. The second thing is that sometimes how much is enough, right? And that is something that I mean you need to work through. I'll spend a little more time on that as well. But I had decided that okay, this is what is enough. In the circumstances, I think 1 crore would not have been sufficient to also take care of my retirement forever. I looked at it and saying that I was young enough, so if I had to get back to work, I said I should be willing to do that. But I not need a capital to secure my family, right, from this risk that I'm taking. So just in case, things don't go right, then I have this capital of mine to uh, take care of a supplementary income, right? So that is something that I'm just giving you insights of how I went it, so that while and if you are looking at entrepreneurial and even doing something which is different, doing something which you enjoy, and which is maybe not as remunerative, I think that is something which one can sort of look at. So this is something that I did for myself, and I'm sure it's something that you should also keep in mind. Now, coming further on the topic of starting early, so if you see, there's a huge difference depending on when you start, right? And we're trying to illustrate that for somebody who's say investing 10,000, just 10,000 rupees a month for 20 for starting at 25, and basically doing it for 35 years. Okay, so when one achieves the 60th age, okay, you would have invested 42 lakhs and it would have become 3.4 crores. Okay, assuming a 10% return. On the other hand, somebody who, let's say, is at 35, has 10 years lesser, okay, even though he's put in 20,000 rupees a month, so invested more in terms of quantum with 60 lakhs, still your corpus at the age of 60 is only 2.5 crores. Okay, so the point I'm making is that the earlier you start, the better. And why is that? This whole this magic of compounding, right? So the unimaginable impact that it has when it compounds over so many years. Of course, we've taken a 10% return out here. It's not, which basically means that it cannot be just debt return. It has to, you should be taking at least a balanced fund or part equity, part debt, and then you may be able to achieve this particular value. So that's the point that I'm making, that starting early makes sense. The other questions that you should be asking yourself is, what should be my investment approach? Okay, one is, when should I start? How early should I start? And then secondly, what should be my investment approach as I come towards retirement? Okay. Now, many times, people come back and say, okay, okay, I take a pension plan and that's it. Okay, no, actually, uh, I would not look at it that way. I think what one would do is look at your whole asset. Okay, and when you look at your whole asset, part of it should be liquid, part of it should be lower risk, lower return. Okay, part of it should be high risk. You cannot achieve everything completely, in one particular app. Okay, so it's good to have a combination of avenues. It's good to diversify in terms of thing. And I'll give you a case study of one of my clients, okay, who was possibly one of the earliest. Okay, in fact, he came right in 2003 when we started the business, and when he came to us, this is what the person had, right? So of course, he also came to us because he had some 23% in cash, and so then he had some mutual funds, interestingly at that point of time, and some equity. In fact, I must illustrate, how he was different from some of the others. Okay, and those are principles that I think can help you go much further. Uh, this client actually came to me early enough and said, "Okay, how do I know that you will be able to take care of my financial plan?" Okay, then he gave me his personal data and preferences and etc. And I almost did a mini financial plan for him. And this mini financial plan, that we did for him, then he got convinced and we sort of went a little deeper and we got into investing. Okay. Now we started much, much earlier than when, he retired. I think that time probably, he was, uh, early in the project management phase. Okay. I know that over the years, his assets would have been maybe larger than possibly even one or at times even two levels higher than him. Okay. And so what made it different? One is even today, uh, he looks at our monthly reports, okay, uh, and he goes back and he does his own math in terms of saying, okay, last month was this month, okay, and so there is an oversight that he looks at it for himself, and when one does that, okay, one is sort of able to manage it sort of in a particular way. Then you are also looking at your own expenses and you're looking at various criteria that you have, right? So once you're conscious about how you manage your money, and I think that's the more important one, then you will be seamless. And you will also go back and see that this is 2018, and he retired from work life in something like 2017 March or something. So that is where the asset allocation was, even 1 year after retirement. And what one would see is, we kept a reasonable amount for him in debt, mutual funds. We kept some bit of it in bonds and debentures, and we kept it in sort of balanced funds. Okay. Now, he as a person was understood market volatility. So I think through market falls also, would listen to us when we told them, it's good to switch money from debt to equity, because at those times it may be very difficult, because when you switch on television and you see the news flow may be very negative. So he was able to sort of manage through his own emotions through downturns and stuff like that, and saw the opportunity that came out from it. Okay, so he had built up a corpus of 7 CR. Okay, now what is interesting is, he also continues to do some consulting and various other you know uh, entrepreneurial pursuits he has. And so he's not necessarily used too much of the capital from where he stopped working, so today, this is where his portfolio is. And because what we try to do is we try to maintain the so if you see the balance funds, we maintain an absolute value, plus or minus, including the debt mutual funds as well as the bonds. We kept that in a particular range, as safety, but we grew the rest of it. And because of that, we also found that in a period from 2018 to 2025, there was a reasonably good growth that he saw in his assets. So the point, so what is that we learn from here? I'm saying a few things. How do you, uh, look at money, track what you do, uh, look at your expenses, etc. Okay, but in terms of asset allocation, we are saying that you might as well have it diversified. Okay, in some cases where people have need regular payouts, then that is something, then we would add a little bit more to the debt, and liquid mutual funds, etc., is something that we sort of add towards and take care of it. Okay. So the points that one should keep in mind, so just extending that into what are the areas that you should sort of look at while setting up your investment approaches. One is you need to diversify. Okay. And like we did for him, in fact, there's no harm in also having equity. There's no harm in taking risk, etc. But it completely depends on person to person, right? So you should have diversification. You need to look at asset allocation based on your own risk appetite and risk preferences. Okay, I know clients, for example, who said, Anil, you know what? I want 1 crore in debt. Okay, rest of it I don't have a problem with. I have some clients who say, you know what? I want to keep 50% of my portfolio or 60% of my portfolio in debt. Okay. Now, those what we also do is we also revalidate from our side, because at times, we have the experience of having so many customers, with us, who are living off the assets that have got built up while they were associated with us. Okay, and many times when they come back and we tell them, yes, this is something that you can do, even if it was earlier than anticipated as well. So maintaining the right asset allocation is important. It's like I've also mentioned earlier. I think liquidity is something that you need to have, and liquidity for two reasons. One is if you have or you need monthly income, then that you need a little bit more in terms of liquid assets. Okay, again, there's some bit of money that you also need to park aside for emergencies. Okay, tax efficiency is the other part. It's always important to look at assets which are also tax efficient. Okay, so look at a post-tax return rather than a pre-tax return. Okay, inflation is something that you need to keep in mind, and this is what I try to illustrate in a very simple way. Okay, because sometimes I think people don't imagine the impact of inflation. Okay, and just to give you, an example, say if you need 1 lakh a month as of today, okay, if your expenses were just 1 lakh a month as of today, uh, in about 8 odd years, okay, you'll need 2 lakhs a month because of inflation. Okay, if you go to, uh, 16 years from, age you go to 16 years, okay, you will need not two, you need 4 lakhs a month. Okay. You do one more cycle of that and you need almost a crore a year. Okay, which is 8 lakhs, per month. Okay, so that is something that one needs to keep in mind. So just imagine, if you have to withdraw 1 crore a year, what is the, asset size that you have to have? Which is why actually, that is something that we were trying to see how to make life simpler for clients. And on our PMS, for example, we added this particular strategy, which I think on the PMS side is the only solution-oriented fund that is available in the country today. Okay, which is basically for regular income requirements. And the reason we started this is we saw a gap because there was no retirement fund that you had, which actually took care of inflation. Okay, many of the pension funds that you have are all fixed. It'll say 5 lakhs a month. Okay. It may be as big as that, but subsequently, it sort of just basically remains there. And you would find that as time goes by, okay, the value of that is only going down. And today, for many of us, right, we are retiring early, or we are sort of stepping out of our jobs early, and the period that we plan for is longer. And even if you look at it in normal, 60-year retirement type of scenario, okay, it's not unusual for life expectancy to be somewhere around 85 years. Okay, which means there's a whole 25 years that you plan for, post retirement and active work life. So that is something that which is why when you're looking at those tenures, you need to plan for inflation. So we created this fund, and we have sort of three variants. Aggressive, moderate, balanced, and then moderate, and then conservative. So we have these three different variants that we have. Okay, and based on that, we reduce the equity. For somebody who's maybe 3 5 years before retirement, then we can start off with an aggressive with a 70% equity, and automatically, basically, this a way, it's a principle that as your age goes up, right, you take lower level of risk. And basically, some call it life stage, asset allocation and stuff like that. Okay, so that is something which you can actually achieve, and we have kept the fund so that it's a variant of it. But the point that I'm just making is, it's important to beat inflation, and we were trying to find a solution where it makes life easier for the client. Okay, and just to give you an indication of returns of this fund, and a weighted average of across all these strategies, the fund has delivered almost like 13.9% per annum on a 5 year basis, right? So in spite of the fact that it has some bit of a good amount of debt in it, okay? So, and we have debt, equity, and we have gold as well. So gold has been, a bit of a balancing figure, and right now gold is like all of us know there's a lot. It's a lot in the news. Okay, so gold has also contributed to returns of the particular thing. So we have a few clients who even they said, I want life simple. They have a significant part of their thing only in this one. So they're saying, why should I break my head on anything else? So that's the type of solution that we try to create. And then the headache is on us, right? We have to say how you ensure that monthly payouts happen, and tax efficiency, and sometimes even taking care of the tax from within the portfolio, and stuff like that. Okay, so this was just an example that one wanted to give on how we have done a structured way of also retirement solution. And what are the steps that coming to what are the steps I should take before I retire, right? So I think one of the first steps that you should take is about stepping back and saying that, let's start a financial, let's, if I have not already done, let's do a financial planning. Okay. And so anybody who comes back to me and says, what, Anil, it looks like I'm going to retire early, I'm going to start up something and stuff. the first advice I give them is, come back and let's do the financial plan. Let's revisit data. Okay. Because then once you revisit your goals and the time with the timelines and look at the assets that you have, the risk profile, etc., then we know that if you have a problem, is there something that you should be conservative, should be aggressive? A lot of insights come to us, and because from here you cannot take a chance. You cannot suddenly say, "Oh, you know what? I've run out of money," right? And in today's scenario, for all of us, we want to ensure that we are not dependent on our children and next generation. So that is something which financial planning is sort of the first thing to do. It's important to assess what is the monthly income. Now, in your financial plan, you may also have a few goals, okay, family goals, let's say children's marriage, etc., which you need to plan for, right? So those are things that you should set aside as part of your financial plan and say, okay, the rest is now there for my retirement. So that is what you do. But in the second phase, you start saying, okay, how much is the my expenses, and try to see where am I spending, etc. And plan for some things which are not necessarily monthly. You may have a lot of expenses that come yearly and stuff. So that is something, and also possibly keep a little bit of a buffer. Okay, is where what one sort of looks at, because you may have property tax payments, you may have your just your income tax payments as well. Okay, so you need to look at all of them to be able to take care of it. It's important to set up a bit of a emergency fund. Okay, capital there for if you need for any requirement. There should be liquidity. In the case that we sort of shared with you, if you see, we've layered liquidity. At first level, we have a liquid fund. Then we have bonds, which are not linked to the market. Then we have dynamic asset allocation funds or hybrid funds, okay, which manage risk well. So that if we hit the top of each of these things, then I'm able to go from one level to the other. So because it's about, if I have excess liquidity, then I have a lower return. Okay, but so you have to balance between emergency as well as and liquidity as a result, and returns, right? So the second aspect is about health cover. Okay, one of the biggest risks is we believe is health risk. Okay, and we've seen cases of clients who, or prospects more than clients, who, have had a particular health incident. And if it is a significant expenses, it has put them back significantly. Okay. So that is something that you need to keep in mind today. Probably the health or the financial risk are arising out of health, any sickness and illness, etc., is possibly higher than a life risk today. Okay, because of the cost of the expenses, and you have to continue to take care of all your other requirements also as you go forward, right? And at times you may find that these are important things to look at there. So health cover, in my view, is always a good thing to have. Now above that, based on experience, because as age goes up, your cost of cover will go up. You can also set aside a health fund. Okay, so that is something that we've done for people as well. Okay, apart from emergency fund, we keep aside maybe in a hybrid fund, etc. Money for a health fund to cover health expenses itself. Okay, so that is something that one can look at again based on experience. And you need to review your accounts. Okay, you shouldn't have too much of EMIs, liabilities, etc. Simplify life. Okay, while you're looking at setting out from active work life. And the last point is actually nothing to do with money. Okay, because a lot of the time, people just spend time on, okay, how do I plan for money? Okay, and we've had a whole lot of cases where, they've not planned for the time, and then they struggle after, they have stepped out from their job. Okay. Like, if we have somebody who has assets above 40 CR, but then said, okay, I'll go and teach, and somehow was not able to survive the classroom, because the students are reasonably aggressive out there. Okay, and today they have AI and all of it to take you on. Okay, even if you're teaching, right? So those are things that he didn't anticipate, and then suddenly he had to step back from some of that. We've had one of clients who've had issues with that. I had a very one of my clients where he just wound down. Okay, and unfortunately, his health also wound down very quickly. Okay. So the point I keep advising people that, beyond money, please plan for your time. Keep yourself intellectually stimulated. Okay. Even if it means you are doing it free of cost, get yourself occupied, help others, etc. Okay. And because somehow in India we don't have too many hobbies. Okay. So look at all of these while you retire. So I'm saying this is as important decision as the financial decision that you should take. Okay. And the point is, when should I take the plunge? Okay. So once you have done the financial plan, okay, and if the numbers are supporting you, then obviously you can take the plunge. Okay. And we've had a whole lot of clients like that who came back, and because they had started early, like I spoke of, the compounding and why starting early, etc. Because they were also, looking at their portfolios and being cognizant of their expenses, balancing, both, enjoying yourself as well as saving for the future, right? Because needs versus wants, balancing them. Okay, and it's not that wants are bad, but and it's good that you are able to experience things in life. Okay, but we saw, a very very sad example of one of our clients, in fact, managed by Rachna, and the spouse, who was in an advertising agency, earning phenomenally large monthly income. Okay, would go to all the uh, let's say concerts globally, and it was all part of a thing. His view was that we should enjoy life today, right? Unfortunately, lost job, and then today, the spouse is sort of supporting, okay, because luckily she had built up some of the assets out there. Well, Rachna continued earlier, was trying to talk to him and convince, and actually, unfortunately, no investment came from there. So I'm just saying, just keep in mind that. It's life is about balancing needs and wants. Okay, and what factors should I focus, should I consider before post retirement? Okay, uh, is one is proper budgeting of all your expenses. Okay, yeah, and I think it's good to have a good idea of your monthly expenses, especially after retirement. Okay, you can do it in multiple ways. You can either look at your bank account and see, okay, what's going out. It's great if you're able to maintain accounts. A lot of apps also there around today. Okay, so those are also things that you can see how to use. Okay, but at least having an assessment of what the spending is like. Of course, some of it can be simplistic, okay, and practical. That okay, that we are paying you out, say, a lakh a month or whatever that figure is. Okay, and when you cross that, okay, is one thing to keep track of it, right? So there are multiple ways of doing it without making it onerous on yourself. Okay, I already spoke of it. I did speak about, needs versus wants, etc. And uh, it's also about important how you review your plan and your portfolio. Okay. So we always like to do, say, periodic reviews. I think that's very, very good for each of you as clients, as investors, to see, how your portfolio is doing, okay, and take necessary corrective actions, or also take advantage of opportunities that come up. Okay, and it's important to. I spoke of doing a financial plan before starting. Okay, on a periodic basis, ideally once a year, but at least every 2, 3 years, it's important to go back and relook at, okay, what did I plan and where am I? Okay. Uh, One aspect that many times, is something that we don't like to talk about. Okay, unfortunately, for us, life expectancy, we don't have control over that. Okay, so we need to plan for the next generation. Again, there we've seen so many unfortunate case studies of children fighting among themselves because there was no clear will. Okay, and so what I always suggest is you need to, see how you can also secure a family for unnecessary fights. Okay, so it may make sense. Okay, the next generation may crib or whatever it is, but actually it is better for them that it is handed over as to what you think is appropriate for them, that you want to hand over to them. Okay, and why not? Because it's supposed to be your money, and you should be deciding how you want to hand it down. Okay, you may want to do add charity to it, etc. So it's very critical and important, and it can help avoid fights within the next generation. How you do it in a secured way will also avoid litigations. Okay, so those are things that take proper advice while you do whatever you do, so that you are safeguarding your legacy as well. Now, for each person, it can be different. Just to give you an example, we have clients who the spouse is not at all interested in management of money, right? So, of course, in some cases, you know, uh, they make us also as witnesses, etc. And so that is the responsibilities that they entrust on us for it. Okay, but even if they have not, where we've seen, cases where it has been, unfortunate and without plan. Okay, then also one tries to help the families and see how we can ensure that transmission happens properly. Okay, so I believe there's a will, it makes it easier. Okay, because at times we found, the spouses come back and say, we're not savvy at all. Okay, just give it to my children. And then we have to push back. Okay, we push back and say, no, it is not the right way to do it. Okay, let us continue to maintain. We can involve the next generation in decision making. Okay, but it's important for assets to be in the spouse's name there. So you have to plan, keeping in mind how literate, how do you bring in checks and balances? We have at times, special children. Okay, so again, those have to be handled a little well. Okay, so each of them, I'm saying, you need to do based on your own circumstances. And lastly, I'll close by what are the common pitfalls that one should avoid. Okay, I think the first one is, not planning for inflation. Okay, I did discuss with you that how uh, you know 12 lakhs a year, uh, in about 24 years you'll need a crore a year, right? So that is something which one needs to plan for. Okay, the second is tax. Okay, many times we say, okay, there's 10% return, but and if I say, in my uh, Excel that the example that I had given, if I say 10% per annum is what this particular asset grows by, then the 10% should be on a post-tax basis. But because otherwise your asset value will not go to that level that what we are planned, right? So it's also about health cover. I did spend some good bit of time on that. Okay, overspending. Okay, I think there are two things I will say: overspending and also under budgeting. Okay, in fact, that is the both of them are sort of important to look at, because many times, the problem is not that we are spending more; it's just that we're not budgeted right. Okay, and I'll give you examples of, say you plan for say a lakh a month for normal groceries and everything else and fuel, etc. Right? But then question, have you planned for your vacations? Okay. Have you planned for, like I spoke of, taxes and other things? okay, property taxes and stuff like that. Have I planned for, I may have made some, investments. I may have some premiums. I may have, so there are a whole lot of things that are required. I may have to just replace my car, right? I cannot hold it for 24 years, right? So those are things that, asset changes. I need to redo my house. Okay, and when we see that, people do that, it's a whole lot of money. So I'm saying that you need to plan for some of the additional, things that are there. Okay, you underestimate longevity. Okay, so that's something that also is there because I remember we were planning for a client at 85 years as for the retirement, and the particular person said, you know what, in my family everybody has a hit on 100. Okay, so that is something which you need to keep in mind and you need to plan for it. Okay, and if there are those circumstances, obviously, some of those experiences we also started seeing. Okay, how do we, be more conservative in terms of the time frame that we look at. Okay, and I believe also at times you have a lot of stuff around illiquid assets, real estate, etc. Okay, in the past, that was a great retirement plan. Okay, because what our grandparents and maybe our parents also would do. Okay, they would have one more house and let it out, right? Now the issue that you have with and if you are letting out a house, you will realize, okay, over a period of time that post all, first of all, you have maybe, if it's an apartment, all maintenance and all of the other costs, taxes, and uh, the tenant is not there for a few months. Okay, then finding, then refurbishing the house. Okay, and all of that is there. And post that, you will find that the yield to the asset value is very low. Okay, so it may be 2 to 3% of the actual value. Now, of course, it may be higher in terms of what you invested amount, but we are talking about what is the asset value, right? The property prices have gone up, and your rent is only 2 3% of that. Okay, now what it would mean is if I need a certain monthly income, I need to have 2 or 3 times the assets if I use financial assets. If I use real estate instead of financial assets. So that is something that you need to plan for, and so real estate in itself may not help you to take care of your monthly income. Okay, so I stop here and I